And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, a Pan-African bank that's invested in your story because your story matters. Good evening. Welcome to the program tonight. And you can imagine being the management at SAA. You're kind of trying to start the exam. Clearly got end-of-year vibes in my head. Start the airline from scratch, get it up in the sky again, get it going consistently, get some new flights going, try and build some goodwill, all of those things. And suddenly you're affected by a pilot strike. And it's just before the school holidays. And it's just before the big festive season. And the pilots do kind of have a point as I see it, because they do seem to be working slightly longer hours than is average. And, of course, you face the competition that there are other airlines in other parts, and the whole thing is internationalized, blah-de-blah-de-blah-de-blah-de-blah. And you can just imagine the difficulty of it. And you also probably just don't have the money. I mean, this is really the issue. On the other hand, maybe you can appeal to the pilots. I mean, how do you try and turn public opinion against them? Probably very tough to do. I think people in society respect pilots. I think correctly so. And so, yeah, very tough. Anyway, let's see how it all pans out. The pilots won 15%. SA is offering 8%. One hopes that they can reach some sort of deal somewhere in the middle of all of that. You know that I'm a skeptic of cryptocurrencies. And let me just say a skeptic light. In other words, I'm not someone who's completely opposed to them. But I'm not at this stage someone who would at all recommend them one way or another. And I will, for the moment, continue to ask critical questions of those who advocate for them. Obviously, my position gets a little weaker when Bitcoin goes past $100,000 per unit of Bitcoin. I have to say, though, and I had lunch with someone who suggested that actually this has all been driven by a kind of artificial scarcity. There is a finite number of Bitcoin. It can't go above a certain amount. And so this value is being driven by scarcity. So then where is the underlying value, if you see what I mean? So let me use an analogy. And if you're a crypto advocate, I'd like to hear your response to this, please. You may well have one, which is that if, for example, I have gold and it has a certain value because it is scarce, even though I know that people can still mine more of it, even if there is suddenly a lot more gold, there is value in the gold. You can use it for things. You can't cryptocurrency. So that would be part of what I'm trying to say. The other thing is I was reminded of a story, John Nathan was talking about it earlier, about how someone in the UK claims to have lost an amount of Bitcoin or amount of a cryptocurrency on a hard drive that's now in a rubbish dump. He wants to go into the rubbish dump and find it. Okay, but if that's the case, there must be a huge amount of Bitcoin that's been lost in that way. So it's lost from circulation. So it just becomes more scarce. So, I mean, what does that do economically? There are all sorts of questions around that. I'd be very interested in your view, please, on 011 883 0702 021 446 0567. Is it just scarcity that's pushing up the value of Bitcoin, or is there something else? I know the short-term surge is, of course, all to do with Trump and his nominee for the Securities and Exchange Commission in the US. And then, of course, just looking at the value of being a chartered accountant. When I was younger and sort of, I didn't do a BCom, but I looked at people who were on that track and thought the world's probably going to open up for you. You'll be able to go almost anywhere in the world. A lot of CEOs have that qualification. They're chartered accountants. Some numbers coming through suggesting that, in fact, places like the UK, even the Cayman Islands, that for some reason might need a high number of chartered accountants, in fact, not going so well. You're finding it quite difficult to find a job. Perhaps here too. We'll talk about that in an hour's time. And then just a reminder, please, have you checked your credit card statement today after that big Face BK scam? 011 883 0702 021 446 0567 and voice notes tonight on 072 702 1702.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, as the parking bays and shopping centres fill up and the schools kind of start to close and the long-distance highways start to get a little busier for the festive season, SAA hit by a pilot strike. Some flights today being cancelled. Pilots say they're being asked to work longer hours than most people in their profession. They're being paid less, they say. They want a pay increase of 15%. SAA offering 8%. As you know, SAA basically starting again after the pandemic. Dr. Guy Leach is the publisher and editor at SA Flyer magazine. Guy, good to hear from you. Obviously, pilots are taking advantage of the timing. SAA is going to need them over the holidays. Do they have a strong case in their demand for higher salaries?
Yeah, hi, Stephen, and nice to be with you as always. Well, they certainly do. The story starts back with Business Rescue, and the pilots took a 50% haircut when everyone else took a 10% cut across the board in terms of their salaries. So the pilots really were set back a long way. Now, obviously, it's argued by many that the pilots were already a fairly privileged and pampered lot, thanks to all the SAPA agreements over the past 20, 30 years. But nonetheless, those agreements were designed to keep pilots on parity with pilots around the world. So the real problem is that pilots these days are now increasingly being tempted to other airlines around the world.
So they want more money. Okay, maybe they have a strong case. Does SAA have the money to pay them? I mean, surely it's still in a difficult position.
Yeah, it's a question I can't give a clear answer to because we honestly don't know how SAA is doing at this stage. They released a sort of a glowing report that they'd made 256 million rands profit, but that was for 2023, April 2023, and that result is not audited yet either. We've no idea how they're doing for 2024, and now we're almost halfway through 2025 already as well. So, but Professor Lamada tells us that they're trading profitably, they're trading sustainably, they're operating profitably. So my view is that the airline probably can afford these increases. And in fact, my view is actually that it cannot afford not to give the increases.
Well, I mean, the airlines surely have the upper hand. Holidays round the corner, the fact they can work in other countries. I mean, all of that must put them in the pound seat.
The airline is very vulnerable at this particular stage. As you rightly point out, it's the beginning of the festive season with the massive travel demand. The airline's only got two very small cards as contingencies to play, and that is that it's just taken or just received those four small Boeing 737-800s from Turkey that they've wet leased with, and those come with Turkish pilots. Also, the management pilots are not allowed to go on strike. So my guess is that they're going to be able to operate about 25% of their flight. Obviously, they'll be able to put a whole number of other passengers that they would normally have flown on code-sharing partners, metal, as they call it, and that might not be a complete loss for them. But I really don't think they're going to. I think they're going to lose about 66% of their turnover. My word! I mean, obviously, if it's costing them that amount of money, this can't go on much longer. They really have every incentive to find some agreement with the pilots. Well, 100%. In terms of revenue and obviously not profit, I did a quick sort of thumbs-up calculation, and I get to a number of about 17 million rand a day in terms of lost revenue from the strike. Sure, can't last like that for much longer. Dr. Guy Leach, thank you very much indeed, publisher and editor at SA Flyer magazine. Have you been affected by that strike? Please, if you were delayed, if you were stranded, maybe your child was stranded and they were flying to meet them, you didn't know where to go and find them, etc., etc., etc. 011 883 0702 021 446 0567.
702. Stephen is on X.
At Stephen Grootes.
A big court ruling in the Supreme Court of Appeal yesterday, all around money and secrecy. Judge's ruling, Steinhoff was wrong to refuse to allow journalists full access to the full report by PwC into what caused the Steinhoff collapse. A summary of the report was made public, but the full report was not made public. The Financial Mail, the Amabhungane Centre for Investigative Journalism, they went to court. They wanted the full report. In the end, they've won. Quite a scathing judgment in some ways, too, against Steinhoff. Sam Souls, an investigative journalist with Amabhungane, someone who's really led investigative journalism in this country in many years in some ways. Sam, good evening. This report, a really important document, it seems to explain exactly what went wrong at Steinhoff. I presume that's why you wanted it. It is that important.
Absolutely. Look, I mean, for such a massive fraud to take place, over a decade, the few high-level individuals, including Marcus Jooste, who's now dead, who are kind of in the spotlight, were likely not the only ones who knew about this, or at least ought to have known about it. There's players in Germany, in the UK, etc., who also haven't really kind of taken the heat, and that's why we wanted this document, so we can pinpoint exactly what went wrong and who either was actively complicit or kind of look the other way.
Have you seen the report already since yesterday's ruling, or do you have to wait until there's an appeal or something?
No, look, I mean, one of the intriguing things is just how hard Steinhoff has fought us against releasing this report. This company is now liquidated. The company that we actually had to eventually sue is a successor company. It's basically a shell or a shelf that is in control of the report. But they fought incredibly hard to prevent us from getting access. And that really, begs the question of what's in there that they are so desperately trying to keep secret. There's potentially an appeal to the Constitutional Court, although we think that has very little chance of success, and perhaps Steinhoff will now see, that it's, that it's the end of the road. But I'm not banking on that yet.
I mean, there's got to be. I mean, so much has been written, said, investigated about Steinhoff, not just here, but in Germany, as you say. I mean, clearly someone still feels they have something to hide. It's astonishing when you consider the heat over this.
Absolutely. We won in the Western Cape High Court. They ruled we should have access in 2022. Steinhoff waited until the last possible moment to appeal, and then they went on a huge detour, applying to introduce new evidence, claiming that releasing the report would place them in jeopardy under first, they claimed, European data protection privacy legislation, and then when the controlling sort of body moved to the UK, they kind of retread that point in relation to the UK data protection legislation, and the SCA threw that out. But really, they have fought shamefully, I think, to keep this out of the public eye.
Sam Soap, thanks very much indeed. Investigative journalist with the Amabhungane Centre for Investigative Journalism.
702. Stephen is on the Money Show.
6 to 8 p.m.
Well, obviously, huge conversations in world markets today about Bitcoin, the cryptocurrency, passing the $100,000 level this morning, eventually hitting $103,000 per unit. The main reason for this surge, after the sort of Trump surge, has been that the US President-elect Donald Trump is nominating Paul Atkins to run the Securities and Exchange Commission. He's seen, I suppose, as an advocate of looser regulations on cryptocurrencies. Professor Stephen Sidney is a professor of practice at the Johannesburg Business School and expert on cryptocurrencies. Stephen, good evening to you. We know the person in charge of the SEC at the moment doesn't really like cryptocurrencies. How different is Paul Atkins?
Oh, we're talking about oil and water over here. The person currently in charge, who was appointed under a Democratic administration, which was Gary Gensler, took a wrecking ball through the crypto industry, along with a great deal of support from people within the Biden administration, from Democratic senators like Elizabeth Warren, from the Fed and various others. And they wanted to stop this thing in its track, and they did a great deal of damage to the industry in large, to the extent, Stephen, to which a bunch of American entrepreneurs, scientists, developers, and mathematicians left America to go set up crypto companies in more friendly countries like Switzerland and Dubai. Now, he is resigning. He's stepping down before he gets fired, I think, by Trump. And the new guy, Paul Atkins, who's previously been an SEC commissioner, I think under one of the Bush administrations, or perhaps even both, has not only expressed his support for the crypto industry at large, which of course includes Bitcoin, but has been an advisor and consultant and lawyer to many of those crypto companies who have been damaged by Gary Gensler. So they couldn't be more different. They're on opposite sides of the spectrum.
So he's pro-crypto. He's going to be head of the SEC. I realize a regulator can really make a big difference. Does it justify this massive surge in value?
So this is sort of a perfect way for crypto. The answer is partially yes. The perfect way for crypto has been the deregulation that you talked about, and which will be certain under Trump. A new chief under Paul Atkins at the SEC who will stop suing companies for sure for trading on the crypto area. But more than that has been a gradual realization by both governments around the world and institutions, big companies, that this is now becoming a safe asset and should make up a part of their clients' portfolios in the case of investment managers, or their own portfolios in the case of companies like MicroStrategy in the US. There are also a number of countries rumored to be stocking Bitcoin as a reserve asset, and there is a bill in front of the American Congress to make Bitcoin a reserve asset. So this pile-up of pressure has suddenly seen the dam walls, I don't want to say completely break, but certainly open quickly enough for it to hit to $100,000. And people are now talking about $150,000 or $200,000 by the end of the year.
I presume it's not just Bitcoin. Other cryptocurrencies will also benefit from all of this.
Yeah, and that makes me nervous. There are a couple of very solid cryptocurrencies, including Ether and one or two others, but there's a whole lot of rubbish out there that has no reason to exist other than they're trying to be copycats. And they're sucking in a bunch of what's called degenerative money. The degens are a bunch of very nice gamblers who go in and they try to make a quick profit. They have no interest in the underlying fundamentals. So from my perspective is, the other crypto coins are all very interesting, but the ones that will survive this bubble, in other words, when there is deflation, they won't crash terribly, are only 3 or 4.
Okay, so I understand that you, if I may call you an advocate of cryptocurrencies, at least for the point of this discussion, but isn't the value in Bitcoin right now is about its scarcity, right? So there's a finite number. That's what makes it so valuable. I realize people mine cryptocurrencies too. But apart from the scarcity, where does the value come from? And I imagine you're going to say, in the store of wealth that will always be there, because of the scarcity?
Yes, I'm going to say that, and I just asked you to compare it to gold. You really don't have to compare it to anything else. Gold has the same attributes of scarcity. The reason why gold has a value and has had a value over thousands of years of human history is because it's difficult to mine and there's not a lot of it, whereas something like steel doesn't have that sort of value because there's a lot of it. So gold was chosen as something that was scarce and required energy to mine, and it then grew a value as a consequence of that. Bitcoin is identical to that in those respects and superior to it in other respects, such as its portability and non-counterfeitability and the ability to divide it into almost infinitely small pieces, etc., etc. But it has the same attributes as gold.
There is a case, as I understand it, in the UK. Someone claims that they have Bitcoin on a hard drive. The computer was thrown away. It's in a rubbish dump. The Bitcoin's there. You see this in movies all the time, by the way. You know, the idea that there is a Bitcoin somewhere, try to find it on a hard drive, whatever. Doesn't that mean that some of that Bitcoin will be lost from circulation forever? I mean, the same can happen to gold, of course, but that surely is what's going to happen.
Yes, in fact, that particular story, I think that particular guy's hard drive, if it is ever found, holds about 500 million pounds at this point of Bitcoin. But the estimates are that 30% of Bitcoins have been lost forever because people lost the password, which means that the supply that was originally baked into the algorithms can now only get to 70% of what was baked in, but that's fine because it's infinite. Well, not infinitely. It's divisible down to very small numbers. So whether the cap, which is 21 million coins, or if it's a cap of 16 or 17 million because the rest have been lost, doesn't really make a difference to the underlying value of the cryptocurrency.
Thank you very much indeed. Do appreciate the time tonight. Stephen Sidley, Professor Sidley, is a professor of practice and expert in cryptocurrencies at the University of Johannesburg.
The Money Show.
The markets.
All right, a little later than we normally do, but thought it was worth getting an update from Norman McKechnie, independent investor. Norman, good evening. A lot of talk, a lot of optimism about Bitcoin. Do you buy it all? I mean, is Bitcoin really the economy of the future?
Stephen, I'm not in that camp, and simply because I don't see an underlying intrinsic value. I think what's driven these things, well, firstly, let's start with gold. Your commentator talked about gold and Bitcoin. Gold's been around for, tens of millennia. And there's been periods of time when it's been up, and there's been periods of time where those gold itself was actually, the price you got for gold, it was difficult to extract it and make a profit. So, we've had a very short cycle here in Bitcoin. Probably goes back to 2012-ish or something like that. 2017 was the first spike. But I think what the major driver is it's really a geared play on equity. So if you go back the last 20 months, the S&P is up 48% and the Bitcoin's up 480%. So it's like a 10 to 1 almost, 10 to 1 in terms of how it's moved up. And I think the underlying factors that are there, firstly, looking at the economy, you've had a lot of debt that's funded growth. And Treasurer Yellen in the US has been fortunate that she's been able to draw down money from the US money market, etc., and fund growth. The problem that you've had with that growth is every dollar of debt has only given you 65 cents of growth. But let's get back to Bitcoin. If we actually look at Bitcoin itself, we've had this excess liquidity. So that liquidity has sort of been with the banks. The banks have lent that money out. They haven't lent it to operating companies, and it's ended up in speculators' hands. So that liquidity, if you look at what's happened in the last 20 months or so, it's been well above trend. And that's been a driver of markets. It's been a driver of growth, earnings, etc. And if we now look at that, that's now come back to trend. And if you look at sort of global dollar liquidity, that's also tightening. I think the further factor that you've got to look at is the amount of money that's gone into the US in terms of property, but primarily into equity and bonds, and obviously things like Bitcoin as well. That's been 80% of the US GDP. The US GDP at the end of December was 27.3 trillion. So you can work out what 80% of that is. It's probably 20-odd trillion. And I think the big issue that you've got here in terms of going forward, I think in the short term with all the news, people positive on Trump, the appointments, etc., that drives Bitcoin. But I think if you actually look at what's actually happening, the growth that you've seen in the U.S. economy has been funded by debt. That debt impulse will be lower next year, and growth will slow. And then earnings will slow. The equity market will come back. And I think with that volatility, you will see similar volatility in Bitcoin. And if the ratio is 10 to 1, it could be nasty. That's really my take on it. And it's probably a bit of it's a long comment, but that's how I feel about it. I don't think it's been around long enough, and there's liquidity that's driven it. Be careful.
Sure. Okay. No, that's very interesting, Norman. Thank you very much. U.S. markets, of course, still records yesterday, probably already records in trading today. How much longer can this last? I mean, we move into next year. Trump takes over in, I think, the fourth week of January. I mean, at some point, things are going to come back to earth. I suppose the question is, how big will that bump be?
Yeah, I think the story has been, if you look at it, obviously we've had an AI story, and I think it's been largely driven by software as a service has been slowing, and those companies that have offered software as a service have now offered AI. But I think the underlying sort of story there goes back to my comment. Debt has driven GDP growth in the US. So you've had stronger economic growth, better than what you've seen in Europe. That's encouraged flows into the market. You've had the Fed working against the Treasury. The Treasury pumping money in, and the Fed trying to slow the economy down with higher interest rates. And I think it's finally coming through. Those high interest rates are lowering inflation. If you look at housing costs, they will come down. So we'll get inflation coming down, interest rates coming down. But I think the sentiment at this point of time is that it's going to be another Trump trade like we had in 2017 when Trump basically took over the presidency. And you had, at that point in time, you had an increase in growth, you had negative interest rates. In other words, interest rates were below inflation, which is basically expansionary. And then we now have a situation where we've had debt that's driven growth, and that debt is going to slow down in terms of the amount that is actually issued to drive growth. With that, you're going to see slowing earnings. The other factor is that you've got interest rates which are above inflation, which is very contractionary, and that will further impact growth. So it's going to be a Trump fade, not a Trump trade, I think, and that's where I think the market's read it wrong. But yeah, we'll see. I think that headwind coming forward, clearly what Trump will do, they will put in policy, but I think what you've got to bear in mind is in terms of putting policy through the Senate and the House, that's progress. It probably takes 12 months. So if you do have a problem, you need to stimulate, you've got a lag of 12 months with the Fed cutting rates and probably cutting more than what people think in order to try and protect growth. So I think it's a very interesting scenario going forward, but it's one that's been funded on debt, and whenever debt has funded things and funded liquidity, be careful.
Norman McKechnie, thank you very much indeed. It's very sober comments there, the independent investor.
WhatsApp Stephen
on 072
702
1702.
A big event this week aimed at increasing our ties of our economy, or increasing the strength of the ties of our economy and the economy of the US city of Atlanta. Main part of the event showcasing opportunities in South Africa with investors from Atlanta. The initiative is with the Department of Trade, Industry and Competition and the Standard Bank Group. The CEO at the Standard Bank Group is Sim Chabalala. Sim, good evening. Thank you for your time on the Money Show tonight. What kind of investment opportunities was the event showcasing?
Good evening, Stephen. Lovely to chat to you as always, and good evening to your listeners. Stephen, the relationship between the US and South Africa is actually very, very deep. There are roughly 600 US companies that operate in South Africa, and they include household names like Amazon, Ford, Google, Walmart, and the list is long. They employ roughly 200,000 people. The FDI stock by American firms in South Africa is about it's about $7.3 billion, whereas that of South Africa in the US is 6.5. The other interesting statistic is the US is the second biggest country to which we export goods, and it's the fourth biggest that we import from. So the ties between these two countries are deep, and they've been running for a long time. So the conversation was about, well, how do we trade more and how do we invest more, both ways.
You know who I have to bring up now, Sim. Donald Trump threatening tariffs on...
I was praying that you were not going to.
I think you know me better. The president-elect threatening tariffs on our products if we use a BRICS currency over the weekend. Obviously, lots of concerns around tariffs. Could Trump kind of really threaten the relationship that we have? And I mean, do I need to mention what's happened with Russia? Do I need to mention the quite deep ties with China that we have? I mean, he's very difficult to predict, and I think that makes the next 4 years very difficult to predict.
Stephen, I think Standard Bank has been around for 162 years, and I think it'll be around for another 162. And throughout that period, we've seen world wars, we've seen, pestilence, we've seen all sorts of difficulties. And I think even in this coming period where there's heightened competition between superpowers, Standard Bank will survive, as will South Africa. It's not given to us to peer into the mysteries of the future, but we do scenarios. We plan and we think through these scenarios. Our standard scenario, the main scenario, is that there will be challenges, there will be difficulties, but there actually will be opportunities, because the world still needs Africa's copper, cobalt, platinum group minerals. It needs our sun, it needs our wind, it needs our agricultural produce, and it needs the productivity coming out of the African continent, and it needs all of the stuff that we produce in South Africa. So whatever the tariff regime in the world will continue to service our clients and service people that are wanting to buy goods and services from South Africa. The long and the short of it is we think we'll be fine.
Okay, interesting way of answering that question. I don't want to ambush you, Sim, but I feel that I must a little bit, but I think you will be prepared for it. There's been a scam during the rounds that started on Friday. People find that money is taken from their credit card account. There's a transaction reference, which is FaceBK, obviously a reference to Facebook. It is a scam. I know it's affected your clients, FNB, I think Capitec too. I'm sure all of the big banks have had clients affected by this. Are you able to try and stop this kind of scam? I mean, you obviously want to protect your customers. What kind of efforts are you able to take to do that? I realize that there are a lot of people who've been affected by this.
Yes, a lot of people have been, but not the majority of our clients. The number is in the hundreds as opposed to the thousands. Secondly, the issue is global. It's not just affecting Standard Bank, nor is it just affecting South African banks. It's affecting global institutions. We're working very closely with the law enforcement authorities. We're also working with the large hyperscalers, all those companies that remove the friction and make it easy and quick for clients to transact. Unfortunately, the bandits have sophisticated ways of standing between us and our clients in those contexts. We're working, as I say, very closely with our own risk managers, our counterparties at the payment institutions and at these big companies, and we are fine. We are fine.
I mean, you work with the FIC, I'm sure. You work with other banks. You work with international institutions. I mean, there are a lot of people who will work together to try and stop this kind of fraud.
There are a lot of people working together to stop this kind of fraud. Yes, indeed. And the focal point here in South Africa would be SABRIC, but also the banks themselves. We've got large teams of people that are poring over these matters and are finding ways to block this kind of activity. And we've been quite successful in the process.
Sim Chabalala, thank you very much indeed. CEO at Standard Bank. Continuing that conversation now, Siphumelele Zondi is our tech expert, and he's been looking at how you actually protect yourself during this time. Quite a few things have been changing around this. So, for example, if you're an F&B customer, you might have had an email this week saying that your credit card will no longer work. The swipe part of it, the magnetic tag part of it, the magnetic stripe, I should say, will no longer work at toll gates, for example. Siphumelele Zondi joins us now. Siphumelele, good evening. We've all been talking about this faced BK scam over the last few days. We're just talking about it now with Sim Chabalala. Different people trying to do different things to keep money safe. F&B, for example, is stopping card payments at toll gates.
Yes, F&B is stopping money at toll gates. Hello, and thanks very much for inviting me again, Stephen. So the issue with F&B is that they're saying that the tolling system in South Africa is going to change its payment system. So even before they change the payment system, they're going to stop card payments because you would know that you can only swipe your credit card when you're going through those toll gates, and you can't use newer technology, like, for example, tap when you get to that toll gate. And there are problems with, for example, when you swipe, and because the strap as well can get affected, and you find that it sometimes no longer works, and it can also be cloned easier than the newer technology, which is the tap technology and other newer technologies. So they're saying for now, until this process is completed, they're going to stop payments. So if they're going to stop card payments at toll gates. So if you're an F&B customer, that means you need to be paying cash when you go through those toll gates during the holiday season, as we know that everybody is going on holiday pretty soon.
I mean, are the new payments methods really much safer? I mean, is tapping better than swiping? It's hard to know.
Definitely, tapping is a lot better than swiping, because you would know that in the past there have been people who've had their cards cloned. For example, when you have your card in your pocket and you find that someone has been swiping it elsewhere. And also with the newer technologies, you find that there's two-tier authentication as well, where you have to, like, for example, before you do certain things, you have to look at your phone before you can then tap your phone. So because you need to be there when the payment is being done, whichever two-tier authentication you use, whether you're using the fingerprint, whether you're using your face, so that ends up being safer than just swiping, where anybody can swipe your card, or where in certain cases your card can actually be cloned by people who want to swipe it in your absence.
Phishing goes up as well at this time. I mean, phishing is when people, I think, steal your details. I mean, how serious is that at the moment?
It's always big. Phishing is, companies, organizations all over also worry about this thing, because it's not just us and our personal details when it comes to phishing. It's even with companies where you find that your work email will get a link that you then click on. When you click on this link, you find that someone somewhere else has stolen details of your company, whichever other details. In this case, it could be someone posing as your bank, and then you click on that link, and then you've given them information, or sometimes they actually prompt you to give them information, because they might say there's a number and there are numbers missing. you wouldn't know that they're saying complete the number. You wouldn't know that the number that you're completing is actually giving away all your details to those particular individuals. So phishing is always problematic, and we always need to be vigilant of getting SMSs, getting emails, and other text messages on different platforms that prompt us to give details when we actually have not done any service with our banks and other systems that we engage with.
I mean, roughly 1/3 of the world's population is now shopping online. There's a reason why Prosus is as big as it is. I mean, if you're running a company, how do you make sure your customers are safe?
I think if you own a company, you need to possibly make methods that could use digital wallets, for example, that two-tier authentication that we are talking about in order to make sure, and also use a payment provider, right? Don't store details, card details yourself, because this is some of the mistakes that those that are making sales online do, is that they want to store card details themselves. Use a third payment a provider, and find other methods of storing that data as opposed to you keeping the data yourself, because you might find that if you keep the data yourself, you're not trained in cybersecurity and how to protect these things. You just merely want to sell goods. So find those that are trained, and also with the viruses as well. Don't just use the virus virus provider that comes with the antivirus that comes with whichever platform that you are using. Add extra security beyond that. So there are different security platforms that are protecting you and also protecting your customers, because it's not just your customers. You might find that you're losing everything, but at the same time, it's your customers that you need to protect in order for them to trust you.
Siphumelele Zondi, thanks very much indeed. Tech expert, do appreciate the time. And of course, just a reminder with that scam, please check your credit card statement. Check your credit card if you can on a daily basis.
The Money Show with Stephen Grootes is brought to you by Absa CIB, a Pan-African bank invested in your story and the potential it can unlock, because your story matters. Absa is a registered FSP.
Well, some suggestions this week that for people who've been leaving the country, chartered accountants who've been looking for jobs in the UK, for example, they're actually finding it very tough going. And we'll look at that in the next half hour. Also, what happens during a share buyback? Why do companies do it in investment school this evening? Nice to have you along with us on The Money Show. 011 883 0702 021 446 0567. Good evening. It's 7 o'clock.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, you might know a chartered accountant who's decided to leave the country and try their luck somewhere else. And being a CA was one of those qualifications that would really open up the world for you. It's the track to become a CEO. It's something that was always, because it's quite scarce, in high demand. You could kind of do anything. It does seem the demand for CAs in certain places is actually dropping dramatically. Graeme Marais is a director at Blue Recruiting. Graeme, good evening. What picture are you seeing in other markets? I mean, places like the UK or the Cayman Islands, which probably has a pretty high CA to population ratio. I mean, are you seeing less demand for people with that qualification in those markets?
Good evening, Stephen. To be on here. That's interesting. I think in the last couple of years, we've spoken a lot about the brand of South African CAs leaving the country and predominantly going into the UK. And this year, we've seen a big shift in that. And I think that given the market in the UK, there's been a huge slowdown in attrition rates within the firms. And as a result, the South African CAs that were traditionally going overseas this year haven't got those opportunities that the years before had.
Why? I mean, is it just that there's no demand for them? Is it just that the British economy, which we know is in trouble, just doesn't stimulate the demand for CAs? Is that the problem?
So, I think a very firm view of CAs, and I think it's probably pervasive beyond just CAs. And I think what we've heard from our clients in the UK is there's huge demand for CAs. They love the CA brand still. The quality of candidates comes out of the cyber CA course is still extremely high. It's just it's because of the local economy. As soon as the economy starts looking doubtful, people stop resigning. They don't want to be the last one in and first one out when things start retrenching. And it's just a sign of what the environment's like in the UK at the moment, predominantly. But there are other entities, other areas like the Cayman Islands, for example, where we're seeing a 33-40% increase in or down in the turn rate. And as a result, people aren't resigning and they're not hiring at the moment. So it's not a product of the Southeast CA quality. It's just a sign of the times in Europe at the moment.
Graeme, I'm going to ask you just to move around a bit, please, to try and strengthen the signal on your line. What's happening here then? I mean, if some people are leaving our market, does that open up space for other people? Is there still demand in our market?
Look, I think what we're going to find next year is the newly qualified CAs that churn into the market. There's going to be 350 or 400 guys who used to go internationally are now looking for jobs in the local market. And I think it's probably fortuitous because I think the market's starting to pick up and we're starting to see the banks are starting to hire a lot more and there's a lot more positivity in the local economy. So it probably dovetails really well. But yeah, I think if I was a newly qualified CA in 2025, it's going to be a lot more competitive than it has been for their colleagues 2 or 3 years ago.
How do you get a job then as a newly qualified CA? I mean, is it just the qualification that people are looking for? I presume you want people who can do other things. I'm always interested in that. CEOs have what's quite a rare combination. Very good with numbers, very good with money, and very good with people too. And that's really, the difficulty. If you have a CA, you're obviously good with numbers. You're obviously good with money. Don't always show that necessarily the people skills are there. How do you kind of stand out from other CAs to try and get a job?
I tell you what, the gold at the moment, Stephen, is data. So if you can combine your CA with an understanding of data analysis, you are really setting yourself apart in the market, and it's such big demand for that combination of the skills. So, yeah, if over and above everything else, yes, your EQ and the way you present yourself is critically important, and that comes with experience. But if you're a CA and you want to set yourself apart, the data analytics part is the most attractive aspect you have on your CV right now.
You've obviously got to do a good interview. I mean, you and I think others are now doing interviews online. I mean, a video interview, is that kind of effective in getting a job?
Yeah, so we've incorporated at Blue Recruiting a CAs Online, which is an online video platform, and especially for newly qualified CAs, your CV looks very similar to the person next to you. And a lot of the time, employers will almost waste time meeting someone that they know they wouldn't want to hire. So we've got these pre-recorded video interviews that really accelerate the recruitment process. So you'd be able to have a good idea of what this candidate looks like before you've set time aside in your diary. And our clients have really loved that just because it really does accelerate that recruitment process. And from a CA perspective, more employers are looking at you and being able to see what your profile is like. So you become more employable and have better options.
I mean, obviously people are going to game that. I mean, they game interviews as well, Graeme, don't get me wrong. But I mean, if you have to do a 5-minute interview, you're going to game that incredibly. You're going to wear your best suit, put on some makeup, you're going to sort out the camera angle, all of that stuff. I mean, it can be quite difficult as the prospective employer to kind of put all of that to one side and actually make a judgment call on whether this person is the best person for the vacancy you have.
Yeah, that's a really good question. The way we see it, Stephen, is it doesn't replace the first interview. It ensures that your first interview is with people that you are most likely going to employ. And I think it'll never, ever replace the face-to-face or at least the Teams interview with a candidate. But the most important thing is you're not going to be wasting a lot of time with a lot of candidates that you know are a no within the first 5 minutes of meeting them.
It's going to be interesting to see how all of this plays out. You talk about how being able to combine sort of numbers and data together are the big thing. And it can be quite difficult to sort of see if the traditional CA qualification is going to move in that direction. I presume it will. That'll be the thing over the next 10 years, the next decade or so.
Yeah, absolutely. It needs to be dynamic. It can't just be reliant on only the IFRS statements. We need to understand data and understand how AI is going to assist and enable us as accountants and CAs. And I think we're getting there. I think it was a little bit slower than we probably would have liked initially, but we are getting there.
And the status of the qualification. I mean, I made the point that it used to be seen as a way to, really the world would open to you because it was a hard qualification to get. You'd probably end up running a company. Is it still seen like that? I mean, as things change, as AI does more and more things, the bare bones of accountancy aren't being done by human beings anymore. Obviously, a lot of it is. But do you think that status that it used to have is still there?
Steve, I think the true test is what does the rest of the world perceive of the CAs, and compared to what the global market can provide in that finance space, the South African CA is still one of the most attractive individuals to have in your business. We constantly checking that and testing that, and the confidence that I've got, must be commended on the the complexity of the exams that they have set. It still is the quality sort of qualification that everyone is still seeking out. I think you do want to bolster it with BI capabilities and data analytics, but it's still as trusted as it was before, which is great for the CEOs.
Graeme, thanks very much indeed. Graeme Marais, Director at Blue Recruiting. In a moment, we'll talk small business and the funding of small business.
702.
Stephen is on the Money Show.
6 to 8 p.m.
Small Business Focus is brought to you by Capitec. No matter the size of your business, Capitec's got you. Well, I mean, one of the questions, of course, around small businesses is the funding that they need. And it sometimes can seem obvious that you should always help a small business with funding. Not quite as obvious as you might think, though. Martin Motshego is the Head of Investment Readiness and Small Business Development at the Small Business Development Agency for Tola. Martin, good evening. Nice to have you. Nice to speak to you tonight. Obviously, there's a huge number of programs, initiatives, grants, whatever it is, to try and help small business. They will give grants to small businesses. How should a small business treat a grant? Is it free money?
Good evening, Stephen. It is not free money, not in the slightest. So it is because of the way our country is set up, the natural inclination is the grants that are received from government, which are just, here's your money, go run with it, do whatever you please. But when it comes to a small business context, it's quite different, Grant funding usually comes with quite a lot of reporting. You have to justify what you are doing with the grant funding, and that takes time. And especially for small businesses whose time is very valuable, especially the owners, that takes a whole lot of time that could be used for more productive activities in the business, and instead they're spent using, doing a whole lot of reporting. That's one element. And the other is, quite often there's mission drift when it comes with grant funding. So you are a baker, you want to be a specialist baker, baking the prettiest cakes, anyone has ever seen. But the grant funding that then says you have to spend your time baking for schools in the townships. So by the time you are done fulfilling the needs of the grant, your home market that you initially went into business to has run away. So those are the type of considerations that an entrepreneur needs to look at when looking at grant funding, that it can actually be to the detriment of the business.
It can be difficult to say no to money, though. I mean, you make such an excellent point. But if you're starting and you're just like, look, let me just start and get going, someone offers you a grant, you're going to say yes. I mean, you'll read the small print, but you still want to say yes.
All about why you are into it.
All right, Martin, we seem to have lost you there. I don't know if you went onto a speaker or something. I don't know if you're still...
Can you hear me?
Yes, we can. Sorry. I was saying, obviously, you'll read the small print, but you'll still want the money.
So, yes, but it all goes back down to why you went into business in the first place, right? And that's why it's very, very necessary to have a good support structure around you. So at Vitola, we usually provide entrepreneurs with a mentor and, a strong support system so that they understand and they don't drift from the reason why they went into business. Now, you can go out looking for grant funding till your eyes turn blue, but, anyone who is a serial grant funder will tell you that the amount of time, effort, and energy that goes into just maintaining and sourcing these grant funds usually direct away from the time that it takes to spend and build the actual business. So if you want to build a sustainable business, maybe don't spend your time going out looking for grant funding.
A lot of people talk about crowdfunding, so, websites and things to do this. I would imagine if you want crowdfunding, you actually have to really have a proven idea first. You have to give people who might give you some money, you have to give them a reason to do it. And I don't know if that's as easy as it sounds. I mean, there's a lot of competition in the crowdfunding space. There are lots of things to crowdfund.
So, on the contrary, crowdfunding is the best way to get validation as to whether or not what you are doing will have a market. So, I mean, aside from doing it the current way of trying to do on websites and stuff, it is effectively the same concept as going to your friends and family and fools and asking them for money. So now, the only difference here is you are pooling together multiple opinions. Never mind the funding, but you're pooling together multiple opinions to prove that what you are actually doing has merit and has people interested. So it's a great way to get validation as to whether or not you're on the right track. And with the amount that you're able to raise from it, gives you even a bigger indication of how much people are willing to part with the money in their pockets in order to support whatever it is you're doing. So it is a tool. It is a great tool. It just needs you to be able to articulate very well as to what it is you are doing.
It forces a level of transparency too, doesn't it? I mean, it's a bit like the JSE in some ways. You've got to prove your concept before people will buy shares. You've got to be very transparent in doing that. When you go onto any of the crowdfunding websites or whatever, you've got to do exactly the same thing.
So, which is why, the ability to be able to demonstrate what you have at your disposal, what you are willing to do, the time and the effort. And that's kind of another thing with fundraising in general, whether it's crowdfunding, even looking for debt, really. You need to be clear on what it is you are proposing and the time and the effort that it takes in order to build out that story is what we call investment readiness. So being able to curate that entire story, being able to supplement it with documentation and compliance, all of those things, they help you build out your proof point. They help you build out what it is you intend to do. So if you're starting out, yes, it's easier to just sell the story and the dreams. But the more established you become, the more you have some kind of market presence, it's then easier to then use your successes as the tool in order to raise the funds.
And then debt. Obviously, you can borrow money. And I mean, some people are pathologically afraid of debt. And some people will see, no, debt will allow me to actually build my business. I mean, the whole point of credit is so important because it basically creates businesses. How do you manage that balance?
Well, ideally, you don't look for debt until you're able to pay for it. It seems like a cliche and pretty straightforward. But as you mentioned earlier, if you are offered money, chances are an entrepreneur is just going to go for it. So the thing with debt is it is entirely under the entrepreneur's control as to what they use it for. So the world is your oyster when you have debt. And the reporting requirements, as I mentioned, for grants aren't really there per se. You don't need to go around convincing people. It is just give me money, I will execute it for this purpose, and I will pay it back once I achieve the purpose. If you have a well laid out plan, debt is the best tool in order to unlock your business because it forces you to make money out of the money that you take so that you can pay it back. And that is what we have found in our work at Fatola is that if you give people debt, well, patient debt, because there are loan sharks out there. If you give people patient debt, developmental debt, they can use it in order to set up all of the right infrastructure they need in their business so that they can then access commercial funding out of it. So with all the funding instruments, though, you need to take the time to build out what you are intending to do. And a lot of people tend to think, I've been running this business, I've been, blood, sweat, and tears for the past 10, 15, 20 years. This should be easy. Everyone should be able to see it. But no, not everyone wakes up with that business. Not everyone goes to work in the entrepreneur's business every day. So they need to be able to carry the onus of I need to explain what I do.
It's so interesting because debt really does concentrate the mind, doesn't it? It makes you work for it.
Look, if you're just scared of what happens if I don't pay, then it actually gets you to focus on, okay, I need to make sure I turn this thing over. And we usually advise that if you're able to turn it over twice, then it gives you the opportunity to repay the debt and still retain something so that you don't have to go out looking for debt next time. But it actually gets one into the frame of mind of, I need to work. Crowdfunding, if I do it or I don't do it, what will they do? Crowdfunding, I can just sweet talk them again next time. Equity, I'll just, call them to a board meeting and I will, lie my way through it. But with debt, because of the implications that come with it, it actually forces one to actually work.
Martin, thank you very much indeed. Martin Tsecho, really do appreciate the time. Such an interesting point there. Head of Investment Readiness at the Small Business Development Agency, Fatola.
Introducing Capitec Business. Sorry for my low voice. Speaking of low, did you know Capitec Business's Print and Pro card machines offer ultra-low fees, 60% less commission than our competitors? We also process payments 3 times faster and offer free next-day settlements 7 days a week. No matter the size of your business, Capitec's got you. Visit capitecbank.coza/business for more. The Money Show.
Investment School.
23 minutes now to 8 the time. Well, from time to time, you'll hear this phrase in business reports that a company is doing a share buyback. And there'll be talks about how much they're doing, what they're trying to do with it, what the aim of it is. We thought that tonight, why a company does it, what it means about money, what it means about the future direction of the company, all of those up for discussion in Investment School this evening. In our studio, I think they haven't seen each other for a while by the sounds of it. Hlelo Giyose, Chief Investment Officer, Principal at First Avenue Investment Manager, and Onan Komo, CEO, founder of the Nkunzi Wealth Group. Gentlemen, we always like reunions on the Money Show. Thank you both very much indeed for coming.
Absolutely. Thank you so much, my brother.
Look, the last time, it's the DA, the ANC, and the EFF in the studio. Not so easy. And that was before MK. Okay. Owen, let me start with you. What is a share buyback?
So a share buyback is basically when a company decides that they would like to buy their own shares onto their treasury. You're reducing the number of shareholders on your share register. You're saying there's some people that believe that your business is not good enough, so they are selling your shares, or it has reached whatever level they wanted to sell the shares at, and you think that the shares are cheap at that price. So a way of creating good returns for the shareholders is obviously saying, let us show the market that we believe in our business, and for that reason, at this level, we are buyers of our own shares. They're selling at 20, we believe maybe they should be selling at 26 rands. So instead of trying to be very creative, we'll do the simple thing, where we'll just buy our shares at a level where we believe that they are mispriced. And that's exactly what share buybacks are.
Okay, so Hlelo, what kind of situation would a company be in when it does that? I mean, it's trying to prove something to the market. It would also need money to do this, right? It would need to be in a position where it's generating cash.
Right. And there are legitimate reasons for companies to consider share buybacks. But let's also be careful that the companies that do it to manipulate earnings. Mm-hmm. So there are companies that would actually borrow money and use that debt to buy shares back. Because in buying shares back, you reduce the number of shares outstanding relative to the earnings that you produce. Your earnings per share go up. And they would typically do that because their share options are, they're trying to reach, they're trying to move the share price high enough for the share options to get into the money. And then once that goose is cooked, they cash in their share options and the CEO resigns or retires, or 5 years down the line, he's invested in the wrong asset, which is his shares rather than the business. But the right way to do it, exactly as Owen says, is that you really want to be, first of all, very cash generative, which means that your business has a reason to exist and has been supported by the market that way. You're earning above cost of capital. You pay dividends. You can pay more dividends, by the way. You can pay a special dividend. Those are the options you have, right? You can increase your dividend payout ratio, or you can buy shares back. Now, buying shares back is very tricky because at what price do you buy them back, right? At what valuation? Price is price, but at what valuation? Some companies buy their shares back really, really expensively, like NVIDIA is probably in that position now. It's generating so much cash, but the company, by all measures, is not cheap, but they're buying shares back.
Owen, how do you tell the difference? How do you know when a company's doing this for the right reason or the CEO just has his eye on the prize? And it's usually he who does this.
So I think it's the environment around the company itself. Analysts sort of put out reports and they've made opinions known to say, this company, we're rating it as a buy, we're rating it as a sell. We think that the company is doing very well. And if you come across a company that is not highly cash generative, and is not sitting on a pile of cash from the past and is deciding to go into a share buyback, then you definitely know that something is going on. And we've got lots of analysts that track, as Hlelo said, issues like when certain strike prices on derivative transactions is going to be hit, and particularly for the very illiquid shares. I think that's where you can misbehave if you're a very naughty CEO or board. Obviously hoping that the boards don't support executives who do this kind of things. But I think that for any liquid company, it's very easy to push your share price up. But you wouldn't be able, in my humble view, to do that with a Microsoft or, one of those big companies like MTN, because you'll need to have a very, very big balance sheet and sit on a lot of cash. And at the same time, you'll have to come with a very big dose of, inappropriate behavior, which would lend itself to you ending up buying your companies at the wrong share price. But if the company is doing well and is sitting on a lot of cash, I think there's no problem in buying back your own shares or, issuing a higher dividend payout ratio than was expected by the market, which also then re-rates your share price higher because people are looking for higher dividend yielding stocks, or you could actually do an expansionary project. But sometimes these companies do so well and there is nowhere else to put cash besides buying their own shares back. And NVIDIA, like Hlelo is saying, and like some other companies out there, are probably getting into this trap where, they're being forced to use the capital and the cash they're sitting on to buy back these shares at a probably very expensive share price.
So, okay, a company decides it's going to buy back its shares. It does need to actually buy them from people who own them. So, Hlelo, this is about shares that are only being traded on the JSE primarily.
Right. So what the company typically does, it would hire an investment bank to actually execute the share buyback program. That buyback program would have been put to shareholders at an AGM, voted on, and once approved for a particular sum of money, the company would contract with a Goldman Sachs or an RMB or ABSA, Standard Bank, whoever, investment bank to actually get into the market and compete with you and I at buying their shares back. And that is perfectly legitimate. In fact, it's a very transparent way of doing it. We always have to ask, isn't it, what guidance the company gives the stockbroker or the investment bank in terms of price to purchase the shares back at, because that's a signal to you as a shareholder about the level at which management thinks its own company is cheap.
Okay, you're getting to something that I've got many questions about the decision to do it.
Yes.
So I had presumed in my head it would be the board. You're saying that it would have to go to an AGM.
Well, I think if we put to the board will approve it, it goes to AGM, it gets voted on.
Right. But wouldn't there always be an incentive by shareholders, because they'll almost always benefit? So they would almost always say yes.
I mean, shareholders?
Yes.
Oh, yeah. I have to say to you that if you were to take a company like Clicks, right? Take a company like Clicks, which is cheating a little bit because Clicks is almost a perfect company, right? A company really has to be that good.
They're going to use that in your advertising.
Right.
In their advertising.
It has to be that good. When I say that good, it has to be that compelling in all its proposition to the market, to suppliers, to customers, and so on, right? If you look at Clicks' track record at buying its own shares back from 2000 right up to today, if you had just held on to Clicks, from 2000 to today, right, which is oftentimes difficult because shareholder registers change. But you are owning an increasing pie of the company as a number of shares contracts, right? You used to own, 1% of the company. Well, let's say you used to own 1% of the company. As I keep buying shares back, you own 2%, you own 3%, you own 4%, right? In a perfect world, which is a Warren Buffett type world, he has possibly ended up owning quadruple times more than he started with, just by owning a company that compounds wealth and buys its shares back. So it's a great thing in a great company if you can find it.
Okay.
And Stephen, to add to that, I think the decision to buy shares back is not necessarily always going to be an easy one, because you might have shareholders that say, okay, we're sitting on this pile of cash and you guys think that we need to buy back shares, but we actually need that money. So our stance is that you need to pay a dividend out. Pay a special dividend out instead, because we need to use that cash, or rather we prefer to get the cash, because there's no guarantee at all that if you do a share buyback, you're going to see a share price aggression. It doesn't guarantee that the share price is going to go up at all, because there might actually be potentially a bigger seller than the company itself, or potentially a big market that believes that the share price is trading at a level where they are happy to sell out, and then the guys just choose to sell instead. But obviously in the long run, the benefit will accrue in the sense that if the company continues to be cash generative, if you're given the fact that there's going to be a lower number of shares in issue, the earnings, like Hlelo explained earlier, look much better because you're sharing the pie with a fewer number of registered shareholders of the business. But people might have different views whether we should pay cash out as dividends or you must buy back shares, and hope that the scenario of earnings going higher does kick in. Okay,
Hlelo, this is very much, might sound like a silly question, but let me just put it to you. So, a company decides it's going to buy back 100,000 shares, right?
Yes.
Do those shares still exist after that?
Well, a company typically buys shares back. Now, it can leave those shares on the register, which means that those shares continue to count as shares in issue.
Yeah.
Or it can take them to Treasury and cancel them.
Takes them to which Treasury?
To its own Treasury.
Yeah.
So it's just an accounting pocket.
Yeah.
In the company's books, where it cancels these shares. When it's canceled these shares, those shares don't exist anymore in reality. So they don't get counted in terms of total number of shares outstanding. And this is how the number of shares that are outstanding as you buy shares back keeps shrinking, and you as an existing shareholder keeps owning an increasing portion of the shares outstanding, right? That only works if the shares get canceled. If they don't get canceled, it sends a negative signal, because what it tells you is, hey, well, look, management may want to reissue these shares again to raise capital to pursue some project, some pie-in-the-sky project, maybe, right? You don't want that. The minute you buy shares back, cancel them, or else, as Owen says, pay a dividend, pay a special dividend, increase your payout ratio. That way we know we're getting the money or the benefit of the money back in our pocket.
Okay, so Owen, if the shares are not cancelled, then which way who decides how they vote at AGMs?
So it depends on the shareholders, right? It's a decision that the shareholders have to make, and it's not something that all the board has to do is to put the question to the shareholders. Guys, we're trying to make this decision, and we need you guys to vote and decide which way you want to go.
So what I mean is, the shares have been bought back, but they have not been deregistered. So they're still being held by the company.
They're still being held by the company, yes.
So then which way do they vote at AGMs?
Like I'm saying, it depends on the shareholders, but the smartest decision to do would obviously, in my perspective, to cancel those shares once you buy them.
I think what Stephen is saying is, you don't get to be told that right up front.
Right.
You don't get to be told that right up front.
Yes.
So you get to be told that the company is seeking permission to repurchase 10% of the shares in issue.
Yeah.
and you take it as, well, this is great. Now, if it's a great company, they'll also tell you, we're repurchasing these shares to keep them in treasury, perhaps to use them again, or they could tell you to cancel them. But oftentimes they don't tell you. What happens is at the next AGM, they tell you, we bought back so much and we've canceled those, right? If they don't tell you that, shareholders will ask, what happened to the shares you bought back? And if you say, well, we'll still have them, well, then why do you need more permission? Why do you need further permission to buy shares back? What are you going to do with those?
Yes.
Right? So if you don't do anything about it in about a year's time, you've pretty much blocked yourself from asking for permission to buy shares back again.
Okay. I'm getting closer to understanding this. Claire Lugayose is the Chief Investment Officer at First Avenue Investment Management, Owen Nkomo, CEO, founder of the Nkunzi Wealth Group. A share buyback, that is the topic tonight on Your Investment School.
The Money Show.
Investment School.
Continuing your conversation in Investment School about share buybacks. Claire Lugayose is Chief Investment Officer at First Avenue Investment Management, Owen Nkomo, founder of the Nkunzi Wealth Group. Okay, so Owen, could a company decide to buy all of its shares?
Jeez, that'll be very.
Is there any reason why they can't?
That'll be very difficult. But you're essentially assuming that the company is sitting on as much money as the market cap of that company.
Yeah,
and I think that is probably almost impossible in my view. What could happen though is in the private sector, something like that could potentially happen, depending on how the company gets priced and valued. Because you do have a right, say, as a founder of that business, to go out, get advisors that say your business is valued at this much. If you've got cash coming from elsewhere, you take that cash and then you can actually buy the company. But a decision can be made, for example, by the business to do a delisting of the entity. Like, for example, we've seen Elon Musk with Twitter, right? Because he had far more money and far more support from other funding backers.
He has far more money now than Twitter because the value of Twitter has collapsed.
Absolutely. Yes. So you can actually do that if you're Elon Musk or if you're a company that sits in an extremely unique position, which you don't have that many of those companies out there.
Okay, so someone decides. Okay, the board decides at the AGM. They decide we're gonna buy back these shares. So you do it on the JSE, goes through an investment bank, fine. But the value of the shares surely goes up just by the announcement. And isn't that a little bit risky? Because what you're doing is, yes, you're putting up the value of your shares and that might suit all of your shareholders, but now you have to spend more money than you might have thought to try and buy these shares back. I think I've explained my question.
Yes, you have. The shares just don't go up on the announcement, but it's new information that gets into the market, and it's positive information, and it signals to the market that there's probably greater value than what the market had thought before. And once the company starts buying shares back, though, you can see it on certain days that the share buyback moves the market, moves the share price more than anything else, right? And this is when you need to start being very thoughtful about watching the company and saying, at what price are they going to keep buying the shares back? Let me just give an example about this, by the way. In the 2004, 5, 6, 7 resource bubble in South Africa on the JSE, Anglo-American got to, I think, a peak of 548 rands. I still remember this, like yesterday. I'm never going to forget it. They were making so much money out of China. They had a share buyback program, right? They were buying shares back. I still remember this, at $520. 2008, the crash happened. And Anglo-American went down to something like 40 rand or something like that. They were buying shares back at $520.
Sure.
Right? So the value at which you buy shares back is very important, right? And it's very important because there are certain things that have to be done first. Number one is invest for the future. Number two, working capital. Number three, keep a certain amount of money to cover your expenses. For banks, the regulator does that for them. A bank will not buy shares back without the SARB saying, yes, and here's the amount. And I've looked at your balance sheet. This is how much your balance sheet can afford or can take. But outside of that regulatory architecture in industrial companies and mining companies, big mistakes can happen from companies or by management of companies who have no business buying shares back at a certain price, a certain value.
That's an unbelievable story.
I never get that. I never get that.
There's obviously quite a lot of them. I mean,
Yes.
when you're facing situations like market crises where markets come down, most of the investors would have bought shares at a wrong price. But it's all about the timing. Where are you in the cycle, you know?
So talking about that, Owen, are there times when you see more share buybacks and times when you see fewer share buybacks? So in an artificial intelligence boom, a company like NVIDIA has the money to do it. They've got nowhere else to spend it. Does that mean then that you're going to have, is it something that happens more often in a boom, as we saw with Anglo-American, or is it something that happens more often in a sort of in a more difficult time?
Look, it's more prudent to do it obviously in a difficult time, because it's a time of fear in the market. And if you believe your business will survive those 2 odd years that most of the recessions or sell-offs last, then it just makes sense for you to say, I picked my company to be here in the next 10 to 20 years, and I believe that these share prices we're seeing here are very wrong. And then you go in and you buy those shares. It just doesn't make sense when the market is very bullish, like the scenario that's just been shared for Anglo-American. If the market is, buying shares aggressively and they're trading at all-time highs, like most markets are doing right now, the NVIDIA story is one we'll have to watch in future, because I do think that they might probably be doing the wrong thing at the right time.
Owen Nkomo, CEO and founder of the Nkunzi Wealth Group, Hlelo Giyose, Chief Investment Officer, Principal at First Avenue Investment Manager. Thank you very much indeed for coming in. Really do appreciate it. Thank you very much.
Thank you.
Thank you.
The Money Show with Stephen Grootes is brought to you by Absa CIB, a Pan-African bank invested in your story and the potential it can unlock, because your story matters. Absa is a registered FSP.
Thanks very much indeed for being with us on The Money Show. Your regular reminder during this time, please check your credit card statement. We'll be back with you tomorrow. It's just gone 8 o'clock.